And you talk a lot about risk on, risk off, and you have several strategies. RORO, the ticker stands for risk on, risk off. Then we have ATAX and JOJO, funds that you manage. Given the market and the volatility surrounding treasuries and high yield bonds, as you just touched on, and as credit spreads have significantly widened year to date, talk to us a little bit about your funds, particularly JOJO, which appears to be a credit rotation ETF, rotating between high yield and long duration treasury ETFs.
Yeah, I appreciate that. And look, I have skin in the game, right? I'm an entrepreneur. I not only do the research they put out there, but I've got my own capital risk launching these funds. And all three of my funds, ATAX, RORO, JOJO, what you see in the background, they're all risk on, risk off strategies. They all have different signals. They're all trying to get to the same place of avoiding big drawdowns in equities. Now, again, the problem this year that I've been faced with, what I've called hell on Twitter, is that risk off has not acted risk off. All three funds rely on treasuries to be the beneficiary when you're in high volatility periods for equities. Now, the RORO in particular has gotten pretty badly hit, but might be having a nice comeback as of late, again, because of that treasury trade. Now, you mentioned credit spreads. Now, credit spreads, yes, they've widened, but only recently have they had some kind of widening. A good chunk of this initial bond market sell-off was much more duration than credit spread widening risk, default risk premiums increasing within the bond market, which is in of itself very unusual in the way this bond market collapse played out. But JOJO is designed to play off of credit spreads widening, meaning that if you want to apply risk on, risk off thinking to the bond market, it's very simple. Risk on is high yield junk debt. Risk off is still treasuries. Why? Because usually when you're in these high volatility periods for equities and the VIX spikes, you see credit spreads widen. Junk debt becomes junkier. High yield becomes higher yielding. And treasuries tend to benefit. Now, I haven't really had one of those key credit event type of junctures for JOJO to really stand out as a bond strategy. But these things will come at some point. I have no idea when. And I've designed my funds to take advantage of those dislocations, even though they're in dislocations in their own ways right now.
So are you risk on or risk off?
The answer is yes. And I'll tell you why I say that. So the strategies are extremely active, right? So the turnover is well north of 1,000% because the anomalies tend to live in the short term. And those that might scratch their heads seeing that, I encourage you to actually keep an open mind, read the underlying research that goes into a lot of the strategies that I run, that goes into the lead lag report itself as well. It's all quant-based, rules-based. It's not based on my opinion. But, the main signals I'm known for, which are utilities, which is a signal used in the case of the mutual fund, and JOJO, treasuries, signal used in the mutual fund, not JOJO, and lumber to gold, which is the signal used for RORO. All of them are different signals. All of them tend to correlate in terms of being risk off when you're in a high volatility, high risk period. But in between, there will be periods where one fund is risk on, the other one's risk off. Now, that's okay, right? Because all that means is that if you're in a period where things are not necessarily aligning in terms of everything being risk off, it would suggest stocks and bonds might both be okay because the expression of risk off is bonds, it's treasuries, right? So when I say yes, I was being tongue in cheek, but the reality is the funds are having different positions as we speak. I don't know how that's going to be by the end of the week or by next week. When it's all rules based, it's not based on your opinion. It's based on following the output, right? And the output, again, like I've said, has not been phenomenal this year. But I have to tell you, it's funny that people always seem to want to look to the right of the equal sign and not to the left. They always want to look at the outcome and not the process. And just because you did not get the outcome that you were hoping for in the single roll of the die does not mean you stop rolling.
And it seems like a lot of people aren't getting the outcome that they necessarily want. A lot of people are anticipating that the markets are going to crash or have already gotten to that point, that we may see a recession. What do you think? Have we reached the bottom or are we just getting started?
Watch the full episode. You can find it at youtube.com/seekingalpha.